I gave a speech at Google a little less than 2 years ago. And I started it this way. I said, even Warren Buffett said that most people should just index. And then I said, I agree with him. And then I left. But then I said, Warren Buffett doesn't index and neither do I. How come? Okay? And the same type of question I get every year when I'm in class, at least for the last 6 or 7 years, someone raises their hand at Columbia and says, hey, congratulations, Professor Greenblatt, on a nice 37-year career, whatever it's been. Great job, but now there are more hedge fund managers, there's more computers, there's more analysts, there's more ability to crunch numbers, there's plenty of evidence to show that active managers don't really add value over time. More or less the nature of the question is, isn't the party over for us? It's just so much harder now than when you started out. So my students are second-year MBAs, roughly 27 years old on average. And so what I say to them is, okay, I'll tell you what, why don't we go back 20 years when you guys learned how to read? Okay? Let's take a look at the most followed market in the world. That would be the United States. Let's look at the most followed stocks within the most followed market in the world. That would be the S&P 500 stocks. And let's take a look at what's happened since you guys learned how to read 20 years ago. And I tell them, from 1997 to 2000, the S&P 500 doubled. From 2000 to 2002, it halved. From 2002 to 2007, it doubled. From 2007 to 2009, it halved. And from 2009 to today, it's more than tripled, which is my way of telling them that people are still crazy. And also way understating the case, because the S&P 500 is an average of 500 stocks. If you lift up the covers and look at the dispersion going on amongst those 500 stocks between which are in favor at any particular time and which are out of favor, and how often that changes, that doubling, halving of an average of 500 stocks is really smoothing the ride. Under the covers, it's really pretty crazy. So if you believe what Ben Graham said, that this horizontal line is fair value, and this wavy line around that horizontal line are stock prices, and you have a disciplined jelly bean counting way of valuing businesses, and buying them when they're far enough below that horizontal line, and if you're so inclined to sell or sell short stocks when they're above the line, the market's throwing us pitches all the time. Okay? The reason active managers don't outperform, we know a lot of them. They're behavioral, they're agency problems. I sat on a lot of big investment boards, and while everyone is patient, they're run by people. Those people have 3-year benchmarks. And, if someone's in charge of U.S. equities, or they're in charge of real estate, or they're in charge of private equity, or whatever, they have a 3-year benchmark. And I'm not saying the good places throw you out of there when you didn't beat the benchmark. I'm just saying they don't throw you a parade when you didn't beat the benchmark. And there's an agency problem, and it's not going away. Good news for value investors. So when people ask me about, the future of value investing, and that's our definition of value investing, active management in an intelligent way, I tell them that most people, are very, don't know how to value businesses. So if you don't know how to do that, you should do it. And then I tell them about a book I wrote called The Big Secret. And I always say it's still a big secret because no one bought it. And I tell them a couple studies in that book. One study looked at the best performing, it was done by Morningstar, looked at the best performing mutual fund. I wrote it in 2011, so it looked at the decade 2000 to 2010. The best performing mutual fund, 100% long U.S. equities for that decade, was up 18% per year. The market was flat during the decade, so beating by 18% a year was pretty good. The average investor in that fund, though, managed to lose 11% a year on a dollar-weighted basis, and you all know how they did it, right? After the market went up, they piled into the fund. After the market went down, they piled out of the fund. After the fund outperformed, they piled in. After the fund underperformed, they piled out. And they turned that 18% annual gain into an 11% dollar-weighted loss. Institutions are no better. I showed a study of the top quartile institutional managers for that same decade, 2000 to 2010. So the ones who ended up with the best 10-year record, here are the stats on those guys. 47% of those who ended up with the best 10-year record spent at least 3 of those 10 years in the bottom decile of performance. So 3+ years in the bottom decile. So you know no one stayed with them. 79% spent at least 3+ years in the bottom quartile. And everyone, 97%, spent at least 3 years in the bottom half. So to beat the market, you have to do something different than the market. Your returns are going to zig and zag differently. So even if you were smart enough, okay, you don't know how to value businesses, fine, maybe you're good at picking managers. But even if you were smart enough to pick that manager who's going to end up having the best 10-year record, almost no one stays with him. So when I think about the future of active management, I would say, versus passive, the active versus passive, I would say that as a business, not very optimistic. There'll continue to be a move to passive. There'll continue to be, I'm not saying that active won't outperform for the next few years, but then it won't a few years later. So most people won't capture that, and they're starting to catch on to that. So I think there'll continue to be a move to passive. I think there'll still be a fee crunch for active. But as a stock picker, I'm super excited. The more people who quit and stop trying to do this. Market is throwing us pitches all the time. We have these opportunities. So the good news, I'm very optimistic as a stock picker. The business of active management, might be so what, I don't know. But it will continue to be challenged, as it probably should, And as always, not everyone can outperform those who are skilled to either value businesses or to find managers and have the discipline. The big secret, by the way, so you don't have to buy the book, not that you could, I can't even give it away. So the big secret is patience, okay? Find a strategy that makes sense to you and have the discipline to stick with it. That's few and far between.
Beating the market is hard because most people don't know how to properly value a business. Stock prices already reflect what most investors think. So finding hidden opportunities is tough. Many rely on trends or emotions instead of looking at the real value of a company. To do better than the market, you need a unique approach, like spotting undervalued businesses or using a strategy others overlook. Following the crowd usually does not work because it often leads to bad timing, like buying high and selling low. Successful investors think differently and stay focused, even when others doubt them. In the end, as Joel Greenblatt says, beating the market takes both skill and discipline.